Hello there. Welcome there to grade 11 economics. This video, we want to look at the past exam paper, whereby we are going to look at paper 2. And we're going to look at the first question on the paper 2, that is our multiple choice section, and also we have got matching words section. So, on our paper 2, we are going to start with the multiple choice part. So, let's subscribe and share to our channel. Let's share the link to our colleagues who are doing grade 11 economics. More typical examination questions are going to be uploaded on this channel. So let's get notified. Let's turn off the notification button. So I'm going back to our question. We are going to start on the uh, multiple choice section, whereby 1.1 reads various options are provided as possible answers to the following questions. Choose the answer and write only the letter A to D next to the question numbers. We're given 1.1.1 to 1.1.8 in the answer book, for example, and then we're given on how to present in the answer book. Then for the first part, 1.1.1, it reads a dash relationship exists between the price of a good and the quantity and demanded of a substitute. So we know that substitutes are goods that can be used for the same purpose. They can be used in place of the other. So typically having those type of goods, let's say we are having good A and good B. So we are saying we can use good A instead of B, or we can use B instead of A. So you can choose between the two. So we are saying the relationship that is being portrayed there is between the price of the good and then the quantity demanded. So basically, we have got the price, two variables that we have, that is price and quantity demanded. So having that now, you'd see that if the price of good A increases, it means the quantity demanded of good B is also going to increase, because as the price of A increases, it means the price of B becomes cheaper than A, and people go and buy the good B. More people go and buy the good B, and its quantity demand is going to go up. So this increase and increase between the two variables, that is the price of good A and quantity demanded of good B, we are going to notice that there is a positive relationship that is existing between the two. So we are having the response that we have is positive there. So we are having A as our correct answer. Then going on to the next second part is 1.1.2. In South Africa, markets for bonds, shares, and computer chips are examples of real-world markets that come close to being dash markets. We're given monopoly, perfect oligopoly, and monopoly. But we know that in these markets that we're given, or bonds, shares, and computer chips, we are seeing that, for example, looking at the market for bonds, bonds are similar products. So as well as shares, as well as computer chips. So we are saying these are similar products that do not change from one point to the other. So we are saying they're not differentiated. When you're talking about bonds, we're just talking about bonds. They are similar. So this is one of the characteristics that we find existing in the perfect market system. So we have got the perfect market structure having that characteristic. So perfect market becomes the correct response that we have there, which is our B. Then moving on to the third, which is 1.1.3, a period during which at least one factor of production cannot be changed is called, and we know that this is the short run period. Remember, the short run period in economics refers to a period in which at least one input, or be it a factor in the production process, is fixed and cannot be changed. So this exactly is what we are having in 1.1.3, that the production cannot be changed. So it means our response there is D, which is representing the short run. So here we have got D as the correct answer. Moving on to the next question, 1.1.4. The cost paid by a business, whether it produces or sells nothing, or sells nothing at all, are called dash costs. And we know that costs do not change with the level of output. Whether we produce 0 units, pay the same amount of costs is called fixed cost. So we have got fixed cost that we have there at A, which represents the correct answer. So we are saying fixed costs they do not change with the level of output. We pay the same amount at each and every level of output, whether they produce 0 units, whether they produce 100 units, we are going to pay the same amount. So we've got fixed costs. Then moving on to the next part of the question, which is 1.1.5. Trade liberalization refers to the, but we know that when we are talking about a trade liberalization, we are talking about the removal or reduction of restrictions or barriers such as tariffs. So in this case, we are trying to promote free exchange of goods and services between nations. So this is what we have in terms of trade liberalization. So according to the responses that we are seeing that at A, we are given free movement of people, and then B, applying of trade barriers between countries, and then free movement of goods and services between countries, and then movement of capital between countries. So according to the explanation that we have given there, you would see that C becomes correct answer, which is explaining about free movement of goods and services between countries. So it's free movement of goods and services, not people. So C is the correct response that we have. Then moving on to the next question, let's just try to see what we have in terms of the next question. So moving on to the next question, let's try to see, we are now going to 1.1.6, which is saying perfectly price elastic demand is represented by a demand curve that perfectly priced elastic demand is represented by demand curve that is, and we know that when we have a perfectly elastic demand curve, we are saying this usually is a rare occurrence that we see in economics, where the quantity that is demanded change infinitely when there is a little change in the price of the product. So if you have a small increase in the price, we are going to see the quantity demanded going to have an infinite change. It's going to be a very huge change that we're going to notice, and this is going to lead to a horizontal demand curve. So we have got C there as our correct answer. And we know that when we are having a horizontal demand curve, typically we are going to have, obviously, we have our vertical axis and we have our horizontal axis. And the demand curve will be horizontal. So this will be the demand curve. So this is what we have. So the representation in terms of the demand curve, this one becomes the demand curve. And obviously, we have got price for the vertical axis, and then we've got quantity for the horizontal axis, and this becomes your point of origin. So this is a demand curve of a perfectly elastic demand. So this is what we have. So we have got a horizontal on C. And moving on to the next question, companies that produce goods or services in several countries without being concentrated in a single country are called just companies. And then we see that according to the response that we have got multinational companies. We know that multinational companies are the ones that are going to have many businesses in different countries. So this is the correct answer that we have, which is going to be D, representing multinational companies. And then we go to 1.1.8, international trade agreements disputes are mediated by this A, we've got World Trade Organizations, B, United Nations, C, International Monetary Fund, and D, we've got World Health Organization. But we know that the correct answer that we have is United Nations and its role to trade. And we know that United Nations role to trade, it promotes peace between countries, of which are within the context of UN. In the issue of peace, the peace is being described as fostering stability, and that stability provides the framework of the expansion of businesses, interest, and trade. So basically, that's what we have in terms of the United Nations. So this explains the explanation that we have there. So we have got our B as the correct answer, which is our United Nations. Then we move on to the second part of the question, which is 1.2, which is on matching words, and reads choose a description from column B that matches an item in column A. I'll write only the letter A to I next to the question numbers 1.2.12, 1.2.8 in the answer book. For example, I give an example of the presentation. So we've got column A, and 1.2.1, we've got a market, and then we look for the explanation matching a market. But we know that a market is a place where buyers and sellers meet. So basically, it's a basic explanation or definition of market. That's what we have. So we try to see on the explanations that we have for column B, which one does match that. So as we go down, we see at C, it reads mechanism where buyers and sellers meet to negotiate prices of goods and services, which is very correct. So we have got C on 1.2.1. Then 1.2.2 says utility, and we know that utility is the certification that is gained by consuming a certain product. So we go to the column B and try to see which explanation does match that. We go down. And if you go to E, it says power to satisfy a want, which is exactly as we are trying to explain. So we have E. And also 1.2.3, we have got inferior goods. So inferior goods, these goods are goods that become less attractive to consumers as their income increases. So as income increases of consumers, they don't buy those. The demand of those products will go down. So this is what we have in terms of inferior goods. So basically, we are having two variables that are there. That is variable of income of consumers and the variable of demand of those products. So when income increases, demand goes down, which is a negative relationship that is existing between the price and the income of consumers. So we are saying um, if the income of those of consumers increase, we are going to we are going to notice a decrease in the demand of those products. So if you look at the explanations that we have on inferior, we are going to go to explanation if demand is in smaller quantity when income increases, which is exactly as we are trying to explain. So we have got F here. Then 1.2.4, constant returns to scale. And we know that constant returns to scale, they occur when the average between inputs and outputs are proportional to each other. So the moment that we have average between inputs and outputs being proportional to each other, that's where we have constant returns to scale. So try to familiarize with our column B to see which one does match constant returns to scale. We can try to go down and see. You see that A is saying production and input increase by the same percentage, which is becomes the correct explanation that we have, which is A. So here we are having A. Then 1.2.5 is shutdown point. Shutdown point, but we know that shutdown point is the point where average revenue is equal to average variable cost, which we are having a D. So here the answer is D. So foreign direct investment, we know that it's a process whereby the foreigners come and open their businesses in our local country, and we say there is foreign direct investment. So they come and purchase assets in our country as in the form of businesses. Then we call it a foreign direct investment. So according to the explanations that we have there, if you go to G, which is saying acquiring ownership of businesses in another country in the form of buildings and capital equipment, which explains foreign direct investment. Then next we have for the G20. Then on the G20, we know that this is a group of countries, and they bring together the world's major and systematically important economies, and would see that they constitute the biggest countries that we have in the world, and you would see that this is being supported by the statistics, which says its members that are part of G20 constitute 85% of global GDP, which is global gross domestic product, total monetary value of goods that are being produced each and every country. If you combine together the world at large, integrating the whole world, we are going to have countries in the G20 having a representation of 85% of that total monetary value. So basically, that describes how powerful the countries are which are inside the G20, and also 2/3 of the world's population also constitute countries that are inside the G20. So examples of countries that we see there, we have South Africa is also part of the G20. We've got UK, which is the United Kingdom. We also have Germany, China, France. There are some of the countries that we see inside the G20. So which explanation do matches G20 there? You could see that we've got H, which is saying strong Western economies, which are also part of the G20. So we have got H here. Then on the last part, we have Kyoto Protocol, and we know that Kyoto Protocol, we can try to see which one matches, Kyoto Protocol in the explanations that we have there. So you'll see that Kyoto Protocol, but on its own, aims to curb the air pollution blamed for global warming. So the air pollution that is blamed for global warming is being kept. So that's what the aim that is there for a Kyoto Protocol. So going to the explanation that we have there, you'll see that the one that meets that explanation is B. The objective is to achieve stabilization of greenhouse gas concentrations in the atmosphere, which is global warming. So we have got a B as the correct answer on the last part. Then we go to the last part of the question, which is now our 1.3, which reads, give one term for each of the following descriptions. Write only the term next to the question numbers. That is 1.3.1 to 1.3.6 in the answer book. Write abbreviations, acronyms, and examples will not be accepted. Very important to take note that abbreviations, acronyms, and examples will not be accepted. We can take note of that. They are not accepted. So on the first part of the question, 1.3.1, the actual price of an individual item at a certain time. We know that this is the nominal price. And products that are identical in all respects, we know that these are similar products that we call homogeneous products. Homogeneous. And then we have value of the best alternative when making a decision. We know that this is opportunity cost, which says the cost of the best alternative are foregone. So the cost is the value of the best alternative. So we call it opportunity. Opportunity cost. And we go to the next one, future changes to rainfall and temperature. And we always know that this is in relation to the explanation of climate change. So we have climate change. And then 1.3.5 are replacing previously imported goods by locally produced goods. So we know that we were previously importing these goods, and now we are locally producing it. And we know that this aspect is we are trying to protect the local industries by trying to replace goods that are being imported so that foreign businesses do not face international competition in the form of those goods that are being imported. And you know this is called import substitution. And on the last part, cost or benefit that spill over to third party, and we know that this is an externality. And this marks the end of our question 1, and our question is got 30 marks. So this is what we have, guys, according to this video. Let's not forget to subscribe and share. More typical examination questions are going to be uploaded on this channel. Let's get notified. We'll meet again in the next video. As for this video, I'm signing out.